G'day folks, welcome back to another currency update. Now the charts are showing a bit of a pullback since our last update, and we're going to go through each of the charts. We're going to include also some back testing in terms of how you should trade, potentially some of the strategies. In terms of looking at some of the deeper dive, do reference the +1 videos, links in the description below, in terms of some of the various strategies you may want to adopt. In terms of the outlook, as of today, July 30, the Aussie US supported by recovery in commodity prices and improving Chinese demand, but headwinds include expected RBA rate cuts and weaker global growth. Bullish momentum faces resistance around the upper channel of 70 cents through to upside to 75 may occur if risk appetite returns. The Euro British pound slight Euro bias is emerging given improving Eurozone PMI data and more cautious ECB tone, while UK growth concerns and expected BOE easing weigh on sterling. Forecasts project resistance in the 87 to 88 area. The Euro-US, pressured recently by a new US-EU trade deal, raising European tariffs to 15%, triggering a sharp pullback from mid-July highs. Still broader US dollar weakness and amid Fed rate cut expectations keeps the pair range bound around 116 to 118, with potential upside towards 120 by the year end. British pound US, weakness as the pound hit a 10-week low around 133 following the EU-US trade verdict boosting the dollar, still supported by sticky UK inflation and possibly Bank of England delay in cutting rates. Short-term range around 133 to 136 with a bullish tilt if UK fundamentals hold. And for the US Japanese yen, trades near 147 to 149 following US-Japan deal easing trade risk and bolstering Japanese assets, while rising US yields support the dollar. A cautious BOJ potential yen appreciation limit further upside. Outlook neutral to slightly bullish on yield differentials. So looking at the Aussie US first, we always look at the long-term trends first to get an idea what it looks like from a longer perspective. On the monthly here, you can see the price is just broken above that moving average range, although notice the moving averages are still trending in a downward trajectory. The CCI is also neutral. The CCI is in that moving average range, and it looks like it may possibly break above if the price does move further to the upside, although it could be just a false break currently. So at the moment, neutral on the monthly. On the weekly, we've got a bullish movement on the CCI as well as the price. So taking long, if you're trading on the daily, taking long trades based on the weekly. Remember, the rule is always trade in the direction of the higher time frame. So the weekly is bullish at the moment. Now on the daily, we only take, again, going long only when the price is above and the CCI is above the moving averages, no matter what strategy you're trading. So here we've got, for example, almost like a triple or multiple tops, if you like, but a declining CCI versus higher highs in the price. It's hit this resistance up here at 66.249, and it looks like it's pulling back. It's currently in a bearish momentum with the price and the CCI below the moving averages. On the intraday chart, we look at the 1 hour chart. So even if you're trading on the 1 hour period, you also go in the direction of the daily. So at the moment, taking short trades only. So you would have gone short during this period. Now, here we had a bearish divergence. Notice the declining CCI peaks there versus higher highs on the price. And had you been going long during that period when the daily was also bullish, you would have noticed this bearish divergence and you would have got out of the trade as soon as you saw that break below in that moving average range. Now, you could have got out earlier when the CCI broke into that moving average range there, so you could have got in there, and then that would have been a false break to go in again long. So even if you're following the price chart, again following this divergence, you'd get out of it once the price breaks below that moving average range based on the divergence alone. Look at the back test. So I've started it back here around about the 14th of April. That's a stop loss approach. You can see there it's been hovering above and below the break even of 100,000. It's currently sitting around 748 more recently. With the average down approach, we've had a few average downs there, a few drawdowns. Now again, always pay attention to what the daily is doing. So whenever it touches the moving average range, get out of the trade in case the price goes against you if you're going long in this case. Or alternatively, do also take note of any divergence. So if you can see there, first of all, it's a good idea to zoom out. You can sort of get a better idea looking at these moving averages for any divergence. You can see there's a little one there, lower highs on the CCI versus higher highs on the price. I didn't mark it, but you would have got out of that one and avoided that drawdown, and so on. I won't go through all of them, but you get the idea. And as I said, on the hourly, you had a bullish divergence here. So if you're going long, that would have been an ideal spot to go long during that period. And again, closing it out once you started seeing a bearish divergence at that point. So for the Euro British Pound on the monthly, the price is above the moving averages, and so is the CCI. So bullish trades only based on if you're going on trading on the weekly. On the weekly, we've got another bullish momentum here. Notice the CCI is pulling back with this week's bearish candle so far. So I might see a bit of a retrace, and the evidence of that is on the lower time frames. So but at the moment, predominantly bullish momentum on the weekly. On the daily, if I zoom in for a moment, you can see here in our last video, we had a bearish divergence. Now since then, literally the day after, that would have been extended to that point there on the CCI. And likewise, the price would have gone just a day higher to that point. So still declining CCI versus higher highs in the price, and that's pulling back. And what we do is we draw a Fibonacci retrace. Looks like it's starting to pull back now. We take it back to the recent low before the divergence started. So you can see there it's already hit the minimum retrace level, and that minimum retrace is a 23.38% Fibonacci retrace. Now this could go a lot lower, or it could bounce from there, so we'll just keep an eye on that, and that's why we look at the 1 hour time period as well, even if you're trading on the daily, to see potentially where the price may go. But at the moment, bearish momentum predominantly based on the CCI breaking lower. Now going to the 1 hour time frame, that's also got a slightly adjusted. Now that's slightly higher. I'd still consider that a double top on the CCI versus higher highs on the price. And again, that broke down quite strongly. Once it broke below that moving average range and the moving averages started bending down, that was a sign of a continuation of that downtrend. Now, in terms of the backtest, what we also look for is any divergence that might, a bullish divergence, and there's none that I can see there. So looking at the backtest, what I've done here now, I've started it, if I zoom out, going back to around the 3rd of April, which is this point here. You would have got in long trades there on the hourly at that point, and you would have got out during that period once you started seeing a decline. Now notice here we had again, I'm zooming out deliberately so you can sort of get a bigger picture from a 50,000 foot view. Sometimes when you zoom in, it's a bit hard to sort of see, the trends. So it's always good to sort of zoom out sometimes and get a bit of bigger picture as to where we're going in terms of especially divergence. Here, for example, just to mark it for you as an example, a peak there on the CCI versus that peak there, and the same period on the price to that peak. It was actually that one there. That was a strong bearish divergence, and it finally broke to the downside. And if you're going long during that period, you would have got out at the very latest around that period there, or when you started seeing the CCI break into that moving average range on the daily. And you can see there you would have got out around there with a small profit, and you would. And the reason I'm showing you this here with the price declining is to show you the effects had you stayed in it. You want to avoid that drawdown. Okay, that was about $20,000 or 20,000 points drawdown on the average down approach. So obviously don't let it run through the whole period. You do follow all these little divergences on the daily, but also the 1 hour period. And then more realistically, you would have got back into the trade once you started seeing around that period there going. In fact, you would have gone short during this period on the daily, based on the daily, and you would have started taking long trades again from this period around about the 4th of June, which happens to be around this area here. And as I said, at the moment, going long, you would have got out at the very latest once that CCI broke into that moving average range, right at the very latest on the hourly here when it breaks below there. So getting out there before you start losing your profitability. So for the Euro US on the monthly, nice big bull run at the moment, last few months. And we've got a bit of a bearish candle at the moment, but still bullish momentum on the monthly. On the weekly, however, we've actually broken into that moving average range of the CCI. So if you're trading on the daily, don't go long yet until we see a decisive move on the weekly momentum. So at the moment, neutral positioning on the weekly. On the daily, hit this resistance at 118.302. It broke down. We had a bearish divergence drawn last time before our last video, and since then it actually did drop below. Didn't quite hit our target range. Let me just zoom in on that one and redraw the Fibonacci's. So it depends where sometimes you draw these. You take it back to the significant low or that low before the divergence started, and you can see there that would have been that 23.38% level. It touched it there, just barely touched it, bounce, and then it's finally broken down into that range again. So, and that was evidenced by this declining CCI. So that divergence, that minimum divergence, has been touched as well. Now, looking at the 1 hour time period, before we go to the back test, let's first look at the naked chart. So again, taking predominantly short trades at the moment based on the daily. Both CCI and the price are below the moving averages, so taking short trades only. And that would have been a nice area to go short. And again, you would have closed it out when the CCI touched that moving average range, near the bottom of that range there. The price consolidated for a number of hours, and then it finally broke down. When the CCI broke down there, you would have got in on that candle, and again closed it out maybe with a small gain at that point, and go in short again on that one, and then close it out again on that candle. So you would have made maybe a couple of small gains there. At the moment, stay out of it, even though the daily is showing short. Wait for the hourly also to break to the downside on the price as well as the CCI. Let's go down to the back test. Now this one I've started on the 21st of May. That was around this point here when the price broke above the moving average, and so did the CCI. Now notice here the CCI was pretty much consolidating and trending sideways with this effect of this bearish divergence versus the price still rising. You can still stay in the long positions during this period, not ignoring the daily CCI, but at least be mindful of where it's going. In this case, it's going long on the price. But what you do have to look out for is any divergence on the 1 hour time period. So for example here, when you started back there, you'll notice here we had a increasing peaks on the price versus declining peaks on the CCI. So again, you would have got out of the trade, long trades at that point there, and have a little gain made down. You would have avoided that little drawdown. And more importantly, back here on this big drawdown, you'll notice here, first of all, you'd be going, probably would have been going short at that point there. So that would have been probably some short entries, but going long during this period, let it run on the price chart. But as soon as you start seeing a bearish divergence, you would have got out once the price broke below in alignment with this bearish divergence there. So you would have got out of the long positions there, and that would have avoided this drawdown as well. For the British pound US on the monthly, bullish momentum with both the price and the CCI, but notice that bearish candle so far this month. On the weekly, neutral positioning, because even though the CCI is below the moving averages, it's probably a bit too early to enter short positions on the daily, because the price may just bounce out of that moving average range. So just be aware of that. I'd like to see it start breaking lower like it did back here with the CCI to start taking short positions. So staying clear if you're trading on the daily on this one, based on the weekly. On the daily, we did have this bearish divergence as well versus the higher highs on the price. Hit that resistance at 137.88, broke down, touched our target range, and then it's bounced out of it, and that's fallen further to the downside. So at the moment, taking short trades only if you're going on trading on the 1 hour time period based on the daily. So going to the 1 hour period, 1 hour chart, again, taking short trades during this period here. And for example, you would have gone short when the price broke below the moving average at that point there, and the CCI was already below, and you would have stayed in the trade and let it ride until the CCI touched that moving average range at that point, one of those candles there, and it would have been a nice little gain. Leave it until it starts breaking lower. Notice the CCI is consolidating, and so was the price until it finally broke below on that hour, that candle. Take a short position. Now this one might have been a break even, then enter it again, another short entry, and then finally close it out near that range there. And then now since then, notice this is why you always be. We've got a double bottom, if you like, on the CCI, and we take it to that point there versus lower lows on the price. So even if you extended it to that point, that's a bullish divergence. And at the moment, the price and the CCI are broken above the moving averages. So in terms of looking at a back test, what I've got here is I've got the short positions, and you would have gone short from around about the 9th of July, around this period, and that's a stop loss approach, and that's the average down approach. Again, taking short entries from that point on the daily. At the very latest, you would have got out when the daily broke into that moving average range. But notice you could have got out earlier had you noticed this bullish divergence back here versus lower lows on the price. So you would have got out somewhere around that point there on both the stop loss approach and the average down approach if you're using that method. Avoid going short again, obviously. We've got a bit of and that's why, again, it's good to zoom out because you can see the trajectory of these moving averages and the price. And then finally go short again, as I said, when the breaks below on both the price and the CCI moving averages. For the US Japanese yen on the monthly, it's broken below the moving averages of the price and the CCI, giving us a bearish momentum, and that was a response of this bearish divergence on the monthly. Again, notice that was a very long-term movement on the bearish divergence. It started back around about 2023, and since then the price has pulled back. Now, also on the weekly, it's actually broken higher than the moving averages, giving us a bullish momentum. So if you're trading on the daily, going long based on that. And we also look for any divergence while we're looking at these charts. There's none there on the monthly or the weekly. And on the daily, if we zoom out for a moment, it's currently above the moving averages on the price and the CCI, giving us bullish momentum, so taking long trades on the hourly. And again, notice back here, that was not really a divergence because they're declining bottoms, and so is the declining bottoms on the price. So no divergence there. And where we are at the moment, there's no divergence there as well. So the CCI is moving in tangent with the price. Now going to the 1 hour time period. So if you're trading on the 1 hour, you look at the daily trend, so going long only. So you would have taken these long trades here. And currently you'd be getting out of the long trades, obviously, once you see the price and this, especially the CCI break below the moving averages. What we're looking for as well is a divergence. Now that's strictly not a divergence to those peaks. So if it's not obvious, don't mark it as such. In this case, it looks like it has been a divergence somewhat, higher highs on the price. So to be strict, I'd like to see it more obvious like it was back here. That's obviously higher lows versus lower lows. This one is a bit iffy, so don't create something if you're not sure. So I'm going to delete those. Whether it breaks down hard or not doesn't really matter. We don't mark it as a divergence. But at the moment, if you're going long during that period, you'd be definitely getting out of the trade, especially when you see the CCI and the price start bending to the downside. In terms of the back test, I've got the longs on this one, and this started back around about the 7th of July when this candle broke above on the daily, and so did the CCI, so going long. And you would have, at the very latest, you would have got out when the CCI on the daily broke into that moving average range near the top there. But again, always, if you're trading on the hourly, always look for any divergence, and you would have got out a couple of times here with a bearish divergence there. Got out around about that point. Avoid going long until such time that both the moving averages start trending up, and then you started seeing another bearish divergence there, which I've marked. Get out of the trade there. Avoid going long. That could have been a little false break. It went sideways, consolidated, but then it started declining. So you probably would have, especially seeing the CCI decline, that's a bad sign. So avoid going long, especially when the CCI is declining. So you would have not gone short here because remember that you're going in the direction of the daily. So just wait it out, especially after seeing a bullish divergence here. The price and the CCI break higher, take long trades. Remember to get an in-depth view of some of the trading strategies, reference the +1 videos, links in the description below. Thanks for watching, hit that like and subscribe, support the channel, and see you in the next video.